Welcome back to the deep dive. Our mission here is pretty simple. We take these really complex, source-heavy topics and we try to distill them into something genuinely actionable for you.
Some insightful knowledge you can actually use.
Exactly. And today we are strapping ourselves in for the world of, well, fast casual dining and equity analysis. We're focusing on a company that you could argue really revolutionized the entire quick service industry. Chipotle Mexican Grill, ticker CMG.
That's right. And for investors, I mean, for anyone watching the market, Chipotle represents this fascinating tension.
Attention, how so?
Well, on one hand, you have a wildly successful brand, a history of these incredible strategic pivots. But on the other hand, its stock valuation just lives in the stratosphere. It's priced so high.
So that brings us to the central question for this deep dive, which is pretty crucial. Does Chipotle's high-growth story and its, widely acknowledged wide moat status, does it genuinely justify that incredibly premium valuation?
That's the billion-dollar question.
We have some pretty comprehensive investment reports in front of us. They lay out CMG's history, its operational strengths, the current financial picture, and, well, the consensus summary seems to suggest a buy-hold posture.
Right, which tells you that while the fundamentals are strong, the price itself leaves very little room for error.
So it's good, but it's expensive.
Precisely. You see these two strong opposing forces right in the data. On one side, you have these undeniably robust, industry-leading unit economics. The efficiency of their restaurants is just almost unmatched.
Okay, that's the bull case.
But then the other side of the coin is this relentless market expectation. It's this demand for near-perfect continuous high growth. And that's happening right as we're seeing recent data showing some traffic softness.
So we need to figure out if the engine underneath it all, especially this big unit expansion plan, can realistically meet the aggressive expectations that are already baked into the stock price.
Exactly. Can the reality live up to the hype?
It's the perfect blend of a strong story and some very demanding math. So let's unpack this. I think the best place to start is at the very beginning. Let's trace the DNA of this brand through its most pivotal moments.
Sounds good.
All right, so the story starts in Denver, 1993. Founder Steve Ells. It's often called the birth of fast casual, but what really made the concept so revolutionary, it wasn't just about making quick burritos.
Well, not at all. It was a fundamental shift in perception. I mean, fast casual as a concept bridged this huge gap between, speedy but often low-quality quick service restaurants.
Your typical burger chains.
Your typical burger chains, exactly. And the full sit-down dining experience. Ells focused on menu simplicity, which was just critical for getting people through the line quickly for throughput. But the real differentiator, the thing that set them apart, was the food with integrity branding.
Food with integrity. We hear that phrase all the time with Chipotle. What did that mean in practice back then?
Well, it was a commitment to fresh, higher quality, often locally sourced ingredients when possible. This just set them completely apart from the QSRs that relied so heavily on centralized processing, frozen patties and whatnot. It established that premium perception from day one.
And it's funny, people often forget that Chipotle had this incredibly powerful early validation. It came from the ultimate QSR behemoth, didn't it?
It did, McDonald's. They actually took a significant stake in Chipotle early on.
Which is just wild to think about now.
It's absolutely critical context for anyone analyzing this company.
Yeah.
McDonald's didn't just write a check. They provided the necessary operational mentorship and, crucially, the insights on how to scale. That's what fueled Chipotle's rapid expansion through the 2000s, leading right up to that 2006 IPO.
So the early backing, it basically confirmed that a giant in the industry saw the potential in the business model long before it became this cultural phenomenon.
It did. The fundamentals were solid, but they needed that scaling expertise. And, well, only McDonald's could really provide it at the time.
So growth was compounding. The brand was a huge success. They held this sort of ethical high ground with their sourcing. But then came the single biggest threat the company has ever faced. The 2015-2016 food safety crisis.
This was the major inflection point. I mean, it shook the company to its absolute foundation. We're talking about a devastating series of E. coli and norovirus outbreaks spread across the country.
And customer trust, which is the cornerstone of a brand built on integrity, just evaporated overnight.
It was severely eroded. The stock suffered its worst drop since the IPO, and the brand image was just deeply, deeply scarred. It was a nightmare scenario.
That crisis, it didn't just hurt sales, though. It exposed a really critical operational vulnerability, didn't it?
It absolutely did. It revealed the Achilles heel of that whole food with integrity model.
How so?
Well, because their supply chain was centralized and so focused on high-quality sourcing fresh, unprocessed ingredients from a limited number of suppliers, when a food safety breach happened,
The damage wasn't contained.
it was systemic and widespread. The reaction couldn't just be a PR cleanup. It forced a total strategic overhaul of their entire system. Management had to pour hundreds of millions into new safety protocols, DNA testing for ingredients, reorganizing all their supply logistics.
So they stabilized the chain for sure, but I imagine that came at a huge cost to their
A
momentum.
huge cost. They lost several years of valuable growth momentum. All their resources, all their focus, it was diverted purely to these defensive internal operations, just trying to stop the bleeding.
So the brand is stabilized, but that high growth story is completely stalled. It needed a new vision. And that vision arrived in 2018 with Brian Niccol.
Niccol, who came from being the CEO of Taco Bell, represented a necessary and very sharp pivot. If you think about it, if L's focus was on product purity and ethos,
why?
the why, exactly. Niccol's focus was on operational efficiency and digital convenience, the how. He understood that modern customers, well, they just wouldn't tolerate slow lines, even for quality food. He brought a QSR mindset to a fast casual model.
And the strategic shift it was radical. What were the key things he implemented right away?
The focus was on eliminating friction, just making it easier to get your food. The launch of the loyalty program in 2019 was massive. But structurally, the biggest change was the widespread adoption of that second make line in the back, just for digital orders.
Oh, right. So the online orders don't clog up the line for people walking in.
Exactly. And then the launch of the double drive-through at Chipotlanes. These changes together let them process this huge volume of digital orders without jamming up the front line. And the results were immediate. Digital sales leaped by over 90% in 2019.
90%.
It shattered the $1 billion mark.
Which turned out to be spectacular timing considering what happened next.
Absolutely prophetic. The COVID-19 pandemic hits in 2020, and all of those digital investments, especially the Chipotle infrastructure, were immediately validated, while the rest of the industry saw their comparable sales just fall off a cliff.
Chipotle was ready.
They could pivot almost instantly to high-volume takeout and third-party delivery. Their digital mix surged. It really proved the resilience of their company-owned model. They had the control to execute these pivots so quickly.
And that modernization strategy under Niccol, that's what really set the stage for where we are today.
It did. It fundamentally drove profit growth by about 5 times between 2018 and 2023, setting the foundation for the current management team and, of course, the high expectations we see baked into that valuation.
Okay, so that brings us right up to the present. We've traced the DNA from a purist start through a near-death experience and into this tech-optimized growth engine. This leads us directly to the leadership team that's now tasked with executing the next big phase of expansion.
Right, and assessing their quality is absolutely crucial for a stock priced for this much growth.
Let's start with the sudden management transition, which definitely raised some eyebrows last year.
Yeah, the exit of Brian Niccol in August 2024 to become CEO of Starbucks was abrupt. And yes, it caused a brief but pretty notable period of stock uncertainty. The market hates that kind of surprise.
And especially with the CEO, who's seen as the architect of the turnaround.
Absolutely. But the board moved quickly. They installed the COO, Scott Boatwright, as the permanent CEO in November 2024. And what that signals is robust continuity planning.
But is an internal promotion always the best move for a high-flying growth stock? I mean, does it suggest a lack of new disruptive vision coming in from the outside?
That's always the challenge, right? But the market consensus, for the most part, views this as a strength. It emphasizes operational execution and culture alignment over, say, a splashy outside hire.
So Boatwright isn't a visionary. He's an operator.
He's an operator through and through. He's been leading restaurant operations since 2017. He's specifically credited with improving employee retention, which is huge in that industry, and, crucially, throughput.
Just how fast they can get burritos out the door.
Exactly. So the existing strategy of digital growth and unit expansion, that remains firmly in place. The executive team overall is rated strong across strategic vision, operational execution, and financial management.
So what was the reason for that little dip in the overall management score then?
That nuance is captured in the one fair rating they received, which is for stakeholder communication.
Because of Niccol's exit.
It was a direct result of the sudden, unexpected nature of his departure. It just left investors scrambling for clarity for a few months. But otherwise, the team has a very strong track record of delivering on their promises and maintaining transparent financials.
Let's Let's talk about the structure of the business itself. One of the defining things about Chipotle, and a key reason for its high valuation, is this strategy of control. They own all their domestic stores, virtually no franchises.
This is a foundational element of the entire CMG story, and it was strategic foresight executed decades ago. Owning every location gives you absolute control over quality, supply chain integrity, and operational consistency.
Which, after the 2015 crisis, must be paramount for them.
It's vital for protecting that premium brand, and crucially, it means they capture 100% of those industry-leading unit economics directly. They're not just taking a royalty slice like a franchisor would.
But that strategy, it demands relentless capital deployment. I mean, they have to fund all of this growth themselves. Does management have the discipline for that kind of CapEx?
They believe they do. Management maintains a very clear, very ambitious long-term target. They want to grow to over 7,000 North American stores.
7,000? What are they at now?
Roughly 3,600. So they're aiming to nearly double their current footprint. That means targeting about 8 to 10% annual net unit growth.
And that aggressive growth, it's the primary driver of their future revenue, right?
It has to be. Especially since, as we'll get into, about 80% of these new units will feature the high ROI Chipotlanes.
Okay, so a strategy of aggressive expansion, all fueled by their own superior profitability. This brings us to their capital allocation strategy, which analysts have rated as exemplary. Why such a high mark?
It really reflects exceptional financial discipline. First, the free cash flow, the FCF they generate, is robust. We're talking around $2 billion annually.
That's a lot of cash.
A lot of cash.
Yeah.
And that money is overwhelmingly directed toward two very shareholder-friendly activities: reinvestment in those new high-return stores and share buybacks.
And they've been aggressive with the buybacks.
Extremely. The company has spent somewhere between $5 and $6 billion on repurchases just over the 2019 to 2023 period. That's shrunk the share float by a really meaningful 10 to 12%.
So if they're so focused on growth, here's a question. Why not use that capital to accelerate global expansion, maybe through a faster, less capital-intensive franchising model abroad?
That's an excellent challenge. And the fact that they explicitly do not intend to pay dividends and they avoid international franchising, it reflects a core belief from management.
Which is what
They see their own internal unit growth pipeline and their own stock as the best possible long-term investments for their capital. By avoiding dividends, they retain the maximum amount of cash for reinvestment and buybacks.
So they're signaling that they believe their stock is often undervalued relative to its growth potential.
Exactly. Making share repurchases a superior long-term use of capital compared to, say, distributing a yield to shareholders. This disciplined approach is why they get that exemplary rating. They prioritize high-return internal growth and return cash strategically, not just opportunistically.
So they're doubling down on what they know works, this high-efficiency owner-operator model. Okay, now let's pivot and really dissect the structure of that business model itself. Let's talk about the famed wide moat.
Let's do it.
When we talk about market size, how much room does Chipotle really have left to run? I mean, the quick service restaurant market feels so saturating.
It is. But the U.S. limited service restaurant market, it's just vast. It's estimated at about $550 billion. Even with all of Chipotle's recent success, their revenue, which is sitting around 10 to 12 billion, is only about 2% of this massive market.
2%? That actually sounds really small.
And that 2% market share is the critical piece of the growth puzzle. It tells you there's a long runway ahead.
So where is their strength concentrated then?
Well, within the much narrower Mexican fast casual category, their share is huge, around 25%. But the overall total addressable market, that TAM, is so massive that their growth is primarily going to be driven by simple geographic expansion.
So just building more stores in more places.
For now, yes. They're opening 75% of new units in existing states, where their brand recognition is already strong, which lowers those initial marketing costs. The international expansion in Canada, Europe, and that Middle East pilot in Kuwait, it's nascent. It's a modest future tailwind, but North American penetration is the immediate focus.
Okay, let's tackle this concept of the wide moat. Why can't competitors just copy the menu, undercut them on price, and steal market share, especially if the economy turns soft and people get more price sensitive?
It's a great question. The moat is really built on two core pillars. One is intangible, and one is very tangible.
The intangible one is the brand, I'm guessing.
It's the brand equity. It's tied to that food with integrity promise.
Yeah.
It genuinely differentiates them from a typical QSR. It's what justifies the premium price point. But, and this is key, that promise is very expensive to keep.
And that brings us to the tangible part of the moat, the infrastructure.
Correct. Maintaining ingredient freshness and quality across thousands of locations requires a massive infrastructure that smaller competitors just cannot replicate. Chipotle operates 26 independently run regional distribution centers, or DCs.
26. What do these DCs actually do?
They're strategically located to ensure quality consistency and that ingredients are fresh daily. This whole infrastructure acts as a key barrier to entry, and it protects the brand equity they've spent decades building, especially since the 2015 crisis forced them to invest so heavily in making that supply chain robust.
Okay, so that's the operational moat. On the customer side, the digital platform is the second critical layer. It creates stickiness, even if the switching costs are technically low.
It creates enormous stickiness.
Yeah.
The Chipotle Rewards app now has approximately 40 million members.
40 million. That's astounding.
It's about 12% penetration of the entire U.S. population. And you asked earlier if these members are just shifting their existing spending from in-store to the app. The data says no. Loyalty members are highly incremental.
How do we know that? How can you tell they're incremental and not just optimizing their existing spend?
Analysts look at two main data points. First, frequency. Loyalty members order significantly more often. Anecdotally, it's around 3 times a month, compared to a much lower rate for a walk-in cash customer.
Okay, so they're coming back more.
And second, average basket sizes for digital orders, especially those made through the app by loyalty members, are measurably higher than traditional e-store transactions. This platform lets them run these targeted promotions that drive that repeat behavior and increase the basket size without resorting to, blanket discounting that would just kill their margins.
So the ultimate validation of this moat, it all rests on the P&L at the end of the day. Let's talk about this industry-leading unit economics.
This is where you see the sheer power of the CMG model. Their average unit volume, or AUV, is around $3.1 million on a trailing 12-month basis.
And how does that compare to the rest of the industry?
That figure places them among the highest in the entire QSR space. They often rival or even exceed the sales of legacy brands, despite having much simpler operations and a smaller menu.
And what does that AUV translate to at the actual store level?
The restaurant-level EBIT margin is remarkable. It consistently hovers around 24 to 25% of sales. Just for perspective, in Q3 2025, it was 24.5%.
And because they own the stores, they keep all of that.
They capture 100% of that 25%. And they achieve this high margin despite the higher food costs that come with their integrity standards. The streamlined operations, the simple menu, that second digital make line, they offset the labor and ingredient complexity.
That efficiency is what drives the incredible returns on capital.
Absolutely. The returns are just staggering. The startup cost for a new store, even including a Chipotle build-out, is manageable. It's about $1.5 to $2.5 million. But the payback period, it's under 2 years.
Under 2 years to recover the entire investment on a new restaurant, that's exceptional.
It is. And this is precisely why Morningstar benchmarks their moat as wide. The typical QSR, they take 4 to 6 years to recoup their investment. Chipotle doing it in less than half that time is the core self-funding engine.
And that's what allows them to execute that aggressive 7,000 store expansion plan and still fund billions in share buybacks.
That rapid high-return cycle is the structural strength that justifies the premium valuation, provided, of course, that they can maintain it.
Okay, the financial returns are clearly superb. Let's drill down now into the operational drivers. I want to focus on the mechanics of that digital adoption and how it translates to those stellar margins.
Right. So the digital story is pretty mature now. It constitutes around 37% of all sales.
Yeah.
But this high mix is more than just convenience for the customer. It's a critical margin lever for the company.
How so?
Off-premise digital orders, especially the ones routed through the Chipotlanes, are just significantly more efficient. And the reason why is they completely bypass the bottlenecks of that front service line.
So you have a dedicated staff making the order on that second line in the back, and the customer just picks it up without ever interacting with the cashier or slowing down the walk-in crowd. So how does that really impact the labor cost per transaction?
It measurably reduces it because it optimizes throughput. Your staff is utilized more consistently. You're eliminating the need to staff and clean a large dining room for those specific orders. And on top of that, digital orders tend to carry a higher average check size.
So the labor costs get spread over higher revenue.
Exactly. It amplifies the profit margin slightly compared to a traditional dine-in order.
And this focus on efficiency, it's basically hard-coded into their future plans. We noted that 80% of new stores are opening with a Chipotle's.
That is management's explicit strategy. They are leveraging that off-premise efficiency to maximize ROI. I mean, their future real estate decisions are being made based on maximizing that high-return Chipotle format. This shift is essential if they want to sustain that high teens earnings growth the market demands.
Let's shift to how they actually get customers in the door. Unlike their rivals, who flood TV with ads, Chipotle's marketing footprint seems relatively light.
That's very intentional. Their marketing spend is low, usually around 2 to 3% of sales.
Yeah.
That's well below many of their QSR competitors who have to rely on deep discounts and constant promotions.
So what's their strategy instead?
It relies on brand advocacy, grassroots social media engagement, and word of mouth that's fueled by the product quality itself. They're selling a perception of value-quality ingredients, not just convenience or a low price point.
So the loyalty program is the real retention machine here. That's what drives the repeat business without them having to do heavy discounting.
Exactly. With 40 million members, the rewards program drives predictable, repeatable, high-frequency digital orders. But what's most important to look at is the source of their comparable store sales growth, their comp sales.
Okay, what is the source?
Recently, comp sales have been buoyed more by higher average checks, meaning they've been successfully increasing prices, than by actual transaction volume.
Okay, that's a key piece of information. So their growth is relying heavily on their pricing power, not on getting more people to walk in the door. They can pass inflation costs directly to the consumer.
It suggests remarkable pricing power, and they're leveraging that high-quality brand perception to do it. But it also presents a huge risk. If they keep relying on price hikes, they could eventually hit a wall where even their loyal, budget-conscious customers start trading down to a cheaper competitor.
So this reliance on price over volume, that's the critical operational tension right now.
It really is.
Turning to operational KPIs, what are the key figures we need to track to make sure this massive expansion plan is staying on schedule?
For revenue growth, the single most crucial KPI is the unit opening pace. Management has guided for 315 to 345 total new openings for 2025. Hitting that 8 to 10% net unit growth rate, hitting it flawlessly, is just non-negotiable for the stock's current valuation.
If they miss that target, future revenue projections are immediately in jeopardy.
Immediately.
And what about on the labor side? Labor costs are rising sharply, especially in states like California. That has to be a headwind.
It's a persistent headwind. Despite this, management claims they have impressive internal labor strength. They cite about 30% lower employee turnover than typical retail or fast food.
And that stability helps with service and efficiency.
It directly supports service quality and efficiency. It helps them maintain those high throughput rates. However, even with great internal stability, external factors like regulatory wage inflation, that mandatory $20 minimum wage in California, for example, are an ongoing, non-discretionary input cost that constantly test the limits of their high operating margins.
Okay, so we've established that operationally, strategically, Chipotle is executing at a very, very high level. Let's bring this all back to the hard financials, starting with those returns on capital.
The metrics here are just phenomenal, and they confirm the efficiency story we've been talking about. Their trailing return on invested capital, or ROIC, has consistently ranged from 20 to 30%. And in 2023, after some restatements and optimizations, it reached an astonishing 45%.
45% ROIC, that's incredible. To give listeners some context, where would competitors usually sit?
Industry norms, even for best-in-class operators like McDonald's, typically sit in the mid-teens for ROIC, maybe 15–16%. Chipotle's superior returns are a direct reflection of that owner-operator model, combined with those rapid 2-year payback periods on new stores.
So every dollar they deploy is just generating significantly more value than it would at a typical franchised QSR.
Far more. That ROIC superiority is the core financial justification for its existence as a premium stock.
And this translates directly into stellar net margins.
Exactly. You see consistent, profitable growth. 2023 net margins were around 13.7% GAAP. Furthermore, management is showing really effective cost control. They're forecasting a slight food cost reduction down about 60 basis points in the 2025 guidance, even with persistent broad market inflation.
So they're successfully navigating the high cost of their quality ingredients.
They are. But the investment story always has a wrinkle, doesn't it? And the most recent data points to a growth moderation. This is the current headwind that really worries investors.
Okay, this is the central tension.
It is. Growth has definitely moderated, and it's primarily due to recent traffic softness. We need to focus on the Q3 2025 comparable store sales. They were marginal, up just 0.3%.
0.3%, that's basically flat.
It's flat. And critically, that entire gain was driven by a 1.1% price increase, which means that transaction volume, the number of people coming through the door, actually declined by 0.8%.
So fewer people are choosing to eat there, but the company is generating marginal revenue growth by having the people who do come pay more.
That's the interpretation. And the forward guidance reflects this risk. Full year 2025 guidance projects low single-digit comp declines. This places incredible pressure on that unit expansion plan.
So the company is relying almost entirely on opening those new 300-plus stores just to maintain its top-line revenue growth.
Yes, because the existing store base is seeing traffic softness, possibly driven by a more cautious consumer environment.
Which brings us squarely back to the premium valuation. Given the excellent fundamentals, how high is the price tag right now, and what exactly does the market expect for that price?
The valuation is significantly elevated. Chipotle trades at a major premium to its large QSR peers. We're looking at consensus forward PE ratios of around 30 times, enterprise value to EBIT multiples around 25.
And how does that compare to others?
A large QSR, like McDonald's or Yum Brands, typically trades closer to 20 times earnings.
A 30x forward PE implies a huge future growth rate is expected.
It implies the market expects continuous, uninterrupted high teens or even 20% earnings growth to just materialize perpetually. And that expectation has to be sustained primarily by flawless execution of that 7,000 store growth plan and further margin expansion from Chipotle efficiencies.
So what's the immediate warning that comes with such a demanding multiple?
The warning is crystal clear. The high valuation leaves absolutely no margin for error. If comparable sales stagnate further, if that negative transaction growth persists, or if the structural limits of that 7,000 store goal come into question, maybe due to real estate saturation or unexpected cost spikes, the market multiple could compress very sharply.
So even if the business remains fundamentally strong, a valuation correction could lead to a significant drop in the stock price.
Yes, the market is pricing in perfection, and perfection is very hard to maintain.
Okay, let's synthesize all of these different risks now, both internal and external. We've mentioned labor and macro headwinds, but what are the really structural risks to CMG's core business model?
I'd say the number one structural risk remains their supply chain concentration. This goes right back to that 2015-2016 vulnerability.
They haven't been able to diversify enough.
Well, they rely on limited suppliers for their key ingredients: beef, avocados, tomatoes. Any disruption from weather, tariffs, even a disease in a crop could directly threaten that food with integrity promise. If they have to substitute quality for availability, the brand equity is immediately at risk, and their margins become volatile.
And we're already seeing that.
We are. The Q3 2025 results already cited beef inflation as a major offset to their other cost management efforts.
So their premium choice of ingredients actually makes them more exposed to commodity price swings than a competitor using cheaper, more processed substitutes.
Precisely. Other risks, of course, include intense competition, not just from incumbents like Taco Bell who compete on value, but also from all the emerging fast casual chains trying to replicate that quality experience.
And the macro headwind?
And the ongoing macro headwind, yes. If inflation and economic softness really push consumers into aggressive trading down behavior, that current trend of negative transaction growth could accelerate and become structural, not just cyclical.
Okay, let's shift gears to governance and forensics. Are there any hidden red flags in their financial reporting, especially given the high-flying stock price?
The record here is remarkably clean, which is definitely reassuring for a high multiple stock like this. The auditor's reports show clean audits. There are no material restatements, no evidence of earnings smoothing, or any of those related party transactions designed to obscure the true financial picture.
And legally?
Legally, they have the routine, industry-typical wage hour and employment class actions,
Which are just standard for a large restaurant operator. But the major food safety litigation was fully settled back in 2019. There are no major new regulatory probes visible.
What about technological risk? They're so reliant on their digital channels.
It seems minimal. The digital platform runs on Amazon Web Services, AWS, which minimizes proprietary tech vendor risk and ensures scalability. So overall, the transparency and governance are strong. But the very nature of operating 3,600 plus physical retail locations just means that perpetual labor and regulatory compliance are continuous cost factors they have to manage perfectly.
Okay, so let's end on the upside. What are the key catalysts that could trigger a reevaluation of the stock and actually justify that premium valuation?
First, and most importantly, is a re-acceleration of customer traffic.
Getting more people in the door.
Yes, we need to see a return to positive transaction growth. And that has to be driven by successful menu innovation, maybe new limited-time offerings that draw crowds, and a successful targeted marketing push. That would signal that the macro softness is abating and that the digital platform is successfully pulling new and lapsed customers back in.
So not just relying on price increases, volume growth is the key metric.
Absolutely. The second trigger is margin expansion. This would happen if commodity and food cost pressures ease significantly, or if the operational efficiency from all those new Chipotlanes fully scales across the newer store base. If they can push those restaurant-level margins closer to 26 or 27%, the market will react very strongly.
And finally, just maintaining the integrity of the expansion plan itself.
Flawless execution. That disciplined, high ROI rollout of new Chipotlanes has to achieve volumes that are higher than the traditional stores, maintaining that crucial mid-50% blended store internal rate of return, the IRR. If management can execute the 7,000 store plan on time and on budget while maintaining those stellar unit economics, then the market will likely continue to reward that premium multiple.
The path to growth is clear, but the execution has to be perfect.
It really does.
This has been an intensive deep dive into what is a powerful, high-quality brand that has also become one of the most demanding stocks on the market. Let's try to review the 3 most critical insights we uncovered today for the investment case.
Okay, insight number 1. The durable moat is real, and it's financial. Chipotle's unit economics, that 2-year payback, those staggering ROIC figures, combined with the immense scale of their 40 million member loyalty platform, create significant competitive protection that very few QSRs can actually match.
They're simply better at generating returns on capital from physical real estate than almost anyone else in the sector.
They are.
Okay, insight number 2.
Operational execution is the ultimate value driver. The management team, now under Scott Boatwright, has an exemplary track record of capital allocation. But they have to flawlessly execute that 7,000 store expansion plan to justify the current stock price. Any persistent decline in transaction volume or any stumble in hitting that unit growth target will be immediately costly for the stock.
And the fine takeaway.
And finally, insight number 3. The valuation premium is a double-edged sword. The market is pricing in near perfection with that 30x forward EPS multiple. We saw the immediate danger in Q3 2025 that transaction dip signals volume risk. Any sustained traffic decline or any significant margin squeeze from supply shocks or labor costs is an immediate and major trigger for a market reassessment.
They've earned the premium, but they have to re-earn it every single quarter.
Every single quarter.
It's a compelling case for a great company, but it's a high-stakes investment because of that price. Thank you for guiding us through those sources.
My pleasure. And for you, the listener, here is a final provocative thought to consider. As Chipotle pursues that incredibly ambitious 7,000 store target.
Okay.
If the company actually reaches this scale, what competitive response from its peers, specifically one focused on aggressively eroding CMG's digital loyalty and directly challenging that food with integrity promise through technology and aggressive pricing, what response will present the greatest long-term threat to its brand equity?
So will a scaled rival finally find a way to make high-quality, convenient food cheaper?
And if they do, will that neutralize Chipotle's pricing power advantage? That's the critical long-term competitive war they must win.
That's certainly something to chew on. That is all the time we have for this deep dive. We'll see you next time.